Imagine waking up one morning and discovering that the foundation of your country's money had quietly been pulled out from under you. The bills in your wallet still looked the same, but something essential had died. On August 15, 1971, President Richard Nixon announced a decision that ended the US dollar's convertibility into gold. Overnight, the promise that had anchored global finance for decades was gone. Most people didn't realize it at the time, but this single event would change everything about money, trust, and the global economy. It was, quite literally, the day money died. To understand what truly happened in 1971, we have to go back decades earlier. For centuries, money had been tied to gold, an ancient metal trusted across cultures. The gold standard was simple. Every unit of currency represented a specific amount of gold held in reserve. It was tangible, objective, and hard to manipulate. After the devastation of World War II, world leaders met in Bretton Woods, New Hampshire to design a stable global monetary system. The result was the Bretton Woods Agreement, which made the US dollar the world's anchor, convertible to gold at a fixed rate of $35 per ounce. Other countries pegged their currencies to the dollar. Trust in money meant trust in America, and trust that each dollar was as good as gold. The United States emerged from the war with the world's strongest economy and largest gold reserves. The new order gave the US enormous power and responsibility. It promised that every foreign central bank holding dollars could exchange them for gold at any time. This convertibility kept the system honest, at least in theory. The global economy grew rapidly, trade expanded, and prosperity spread. For nearly 2 decades, it seemed the world had found a formula for lasting stability. But beneath the surface, cracks began to form. The system relied on a delicate balance. There had to be enough gold to back all the dollars circulating around the world. As global trade increased, the demand for dollars surged. The US was effectively exporting dollars to finance Europe's and Japan's recovery. Yet the gold reserves at Fort Knox were finite. The number of dollars in circulation began to exceed the gold available to redeem them. The math stopped adding up, even if few wanted to admit it. During the 1960s, the United States faced mounting fiscal pressures. The Vietnam War, the space race, and expanding social programs all required vast government spending. To fund these commitments, the US printed more money and ran growing deficits. Inflation crept upward, eroding confidence in the dollar's stability. Foreign governments began to ask themselves a dangerous question. What if the US actually couldn't deliver the gold it promised? As that question spread, the incentive to act on it grew. If you were a foreign government holding billions of US dollars, it made sense to redeem them for gold while you still could. Quietly, countries like France began demanding their gold back. Gold flowed out of the US Treasury in a steady stream. By the late 1960s, the American gold supply had dropped dramatically, while the number of dollars abroad had exploded. It was only a matter of time before the system would break. Officials in Washington were alarmed. They tried to defend the system through mechanisms like the gold pool, where Western central banks coordinated gold sales to maintain the $35 price. But the effort was like holding back the ocean with a broom. The fundamental imbalance, too many dollars chasing too little gold, couldn't be fixed by policy coordination alone. The more the US printed, the weaker its promise became. Confidence in the dollar's convertibility eroded with every passing month. By 1971, the crisis was unavoidable. The United States faced a stark choice: either devalue the dollar against gold or abandon the gold link entirely. President Nixon and his economic advisors met at Camp David in August of that year to confront the dilemma. Their conclusion was clear: defending the old system would drain US gold reserves completely and risk a catastrophic loss of confidence. Something drastic had to be done. On the evening of August 15, 1971, Nixon addressed the nation on live television. In calm, reassuring tones, he announced what he called a temporary suspension of the dollar's convertibility into gold. It sounded minor, technical even, but in truth it was revolutionary. The promise that had defined global money for over a century was now void. The dollar would no longer be as good as gold. Nixon framed it as a defensive measure against international money speculators, but it was really an admission that the old system could not survive. The next morning, the world woke up to a new monetary reality. Stock markets scrambled to interpret what had happened. Foreign exchange markets went into turmoil. Other currencies, which had been tied to the dollar, were suddenly adrift. Within months, the Bretton Woods system of fixed exchange rates collapsed. Currencies began to float freely against one another. The age of the gold-backed dollar was over, and a new era of fiat money, currency backed only by government decree, had begun. In the short term, the move seemed to work. The dollar's decline made U.S. exports more competitive, and Nixon's simultaneous wage and price controls briefly tamped down inflation. The president's popularity rose, but the long-term effects were far more profound. By severing the tie between money and gold, the U.S. had unleashed a force it could no longer easily control. Money could now be created at will, limited only by political will and economic theory. Without gold as a constraint, the world entered a new age of monetary experimentation. Central banks gained unprecedented power to expand or contract the money supply. Governments could finance deficits through borrowing and printing rather than taxation. Economies became more flexible, but also more fragile. The result was a decade of turmoil, oil shocks, stagflation, and currency crises. The promise of stability that Bretton Woods had delivered was gone. During the 1970s, inflation surged across the developed world. Prices soared, wages struggled to keep up, and the purchasing power of ordinary people eroded. In the US, inflation peaked at double digits. The sense of economic order that had defined the post-war years dissolved. Many economists trace this turbulence directly to the decision of 1971. Once money lost its anchor, its value depended entirely on government discipline, and that discipline proved elusive. The shift to fiat currency also transformed the financial system itself. Debt became easier to create and cheaper to service. Governments borrowed more, corporations leveraged more, and consumers followed suit. Credit expansion became the lifeblood of economic growth. This was the birth of the modern debt-driven economy, where prosperity and borrowing became inseparable. The architecture of global finance, derivatives, complex banking, speculative markets grew from this foundation. Attempts were made to patch the system. Later in 1971, major industrial nations met again and signed the Smithsonian Agreement, trying to stabilize exchange rates. It was, in essence, Bretton Woods 2.0, a last-ditch effort to restore order, but it failed within 2 years. The forces unleashed by the Nixon shock were too powerful to reverse. By 1973, currencies were fully floating and the world had accepted a new paradigm. The dollar was dominant, but no longer backed by gold. What followed was an era of both innovation and instability. Central banks experimented with monetary policy tools that would have been impossible under a gold standard. The global economy grew immensely, but so did financial inequality. Asset prices boomed, debt levels climbed, and speculative bubbles became recurring features of the landscape. The stability of the old system was gone, replaced by cycles of boom and bust that we still live with today. The deeper consequence of 1971 was psychological as much as financial. Money was no longer a promise tied to something real. It was a symbol of collective belief. Trust shifted from gold to government, from something physical to something political. When people talk about fiat money, they mean precisely this: currency that exists because we all agree it has value. That agreement is fragile, and when it cracks, chaos follows. Over the decades, the effects of that shift have multiplied. The dollar remains the world's reserve currency, but its purchasing power has declined dramatically. What 1 ounce of gold bought for $35 in 1971 now costs over 50 times as much in dollars. The implication is clear. The dollar has lost more than 98% of its value relative to gold. Inflation has become a constant feature of modern life. Every generation since 1971 has lived in the shadow of that decision, whether they realize it or not. New technologies and ideologies have emerged in response to this unanchored world. The rise of cryptocurrencies, for instance, is often described as a rebellion against fiat money, a search for digital gold in a system people no longer fully trust. Gold bugs still argue for a return to sound money. Economists debate new anchors, perhaps energy, commodities, or even algorithmic control. Yet no alternative has yet replaced the system born that August evening. The paradox of 1971 is that while it solved an immediate crisis, it created a permanent uncertainty. The world gained flexibility but lost discipline. Monetary expansion became the default tool of politics, and the line between fiscal responsibility and short-term expedience blurred. The lesson, perhaps, is that systems based on trust are only as strong as the integrity of the people managing them.
Half a century later, echoes of that moment still shape every economic debate. Questions about inflation, debt ceilings, and currency wars are all descendants of 1971. Each time a central bank prints money to stabilize markets or a government spends beyond its means, we are living in the world that Nixon created. The gold window may have closed, but its ghost lingers over every financial decision. What's striking is how few people realize that this shift even occurred. Ask the average person when money stopped being tied to gold, and most won't know. Yet it changed the meaning of money itself, from a claim on something tangible to a claim on government credibility. It redefined wealth, debt, and value for generations. And as history shows, once that credibility falters, societies pay the price. Today we face new versions of the same dilemma. Governments around the world are burdened with record debt. Central banks are once again printing money to sustain growth. Inflation fears are returning, and the global financial system is strained by inequality and speculation. The question looms: how long can a fiat system sustain itself before faith begins to crack? History suggests that no system built solely on promises lasts forever. The story of August 15, 1971 is not just about economics, it's about human nature. It's a reminder that trust, once broken, can never be fully restored. It's about the tension between control and chaos, between discipline and desire. Money, at its core, is an agreement, a shared illusion. In 1971, that illusion changed form, and we've been living with the consequences ever since. So what can we learn from the day money died? First, that promises matter. Once you detach value from reality, discipline must come from somewhere else, or it disappears. Second, that flexibility always carries a cost. When governments can create money freely, temptation grows. And third, that history doesn't repeat exactly, but it rhymes. The collapse of the gold standard wasn't just a financial event. It was a turning point in civilization's relationship with value itself. If another anchor were to fail today, the shock might be even greater. Perhaps the real question isn't whether it will happen again, but whether we'll see it coming next time.